80,000 borrowers are about to hit their trigger point if the Bank of Canada decides to continue to raise the interest rates. The Bank of Canada is expected to raise the interest rates again in a couple days, and this has a lot of borrowers worried about hitting their trigger point or their trigger rate. Now, this is the point where you are no longer getting ahead on your mortgage, but you are actually falling behind. You don't want to stick around because I'm going to go over exactly what the trigger rate and the trigger point mean. They are often confused as the same thing, but they are totally different. So today we're going to be discussing what exactly the trigger point and the trigger rate means. Now, before we get into this, do me a favor, hit that like button, hit subscribe, and that notification bell so that you can help other people just like you see this video. Now, the chances is that if you've gotten a mortgage within the last couple of years through a mortgage broker, except if you got a mortgage through TD Bank or TD Canada Trust, you are on a variable rate mortgage with an adjusted payment plan or a adjusted rate variable mortgage plan. And if that's the case, then this video isn't necessarily for you. So let's get into it. Let's talk about what the trigger rate is and how it affects variable rate mortgages. Now let's look at why variable mortgages have trigger rates. And this is because the bank wants you to continue to pay down your principal every month so that you continue to gain equity in your house. Now, there is a difference between a trigger rate versus a trigger point. The trigger rate is the interest rate level where your interest payments are the same as your fixed payment and nothing goes towards the principal. The trigger point is when the outstanding principal amount, including any deferred interest, exceeds the original principal amount. So let's look at an example here. This is Logan. He just bought this beautiful house. He's on a variable mortgage with fixed payments at 3% with a 4.5% trigger rate, $2,000 a month with the principal breakdown as follows. We will use this as an example to show you what happens when the Bank of Canada decides to raise the overnight interest rate. So if the Bank of Canada decides to raise by 0.5%, his new interest rate level is 3.5%, and you will notice that less money goes towards the principal and more money goes towards the interest. So when the Bank of Canada does the same thing again, it increases it to 4%, and again, the principal amount goes down and the interest rate amount goes up. Now, eventually, the Bank of Canada will increase the rate again, and it could do it above the trigger point, which then more money will go to interest than the fixed payment. But let's look at 4.5% we hit the trigger rate. And this is where the $2,000 fixed payment and nothing goes to the principal, it all goes towards the interest. Now this is where we run into the problem. It messes up the amortization period. An example is if you have a 25-year amortization schedule and you're 2 years into your 25-year mortgage and you're 23 years left. Now that no money is going towards the principal, each month that passes adds more time it will take to pay off the mortgage. Now at this point, when Logan hits the trigger rate, he will get a letter from the lender stating that he has reached the trigger rate and that he should consider adjusting his payment, making a lump sum payment, or convert to a fixed rate mortgage. Now, let's just say he decides not to take any of these options. He decides to keep everything else the same. Well, at this point, the interest is higher than the fixed payment, and that extra $300 difference starts to be deferred, which then comes out of the equity of the house and gets put towards the principal amount owed. Now, the trigger point happens in conventional mortgage when the loan to value ratio goes over the 80 to 100% loan to value ratio. In a insured mortgage, which is when you have about 5% down and 95 to 100 loan to value ratio, is when it goes over 105 to 100 loan to value ratio. Once this happens, he hits the trigger point and he must do one of these things. He must increase his payments, he must make a lump sum payment, or convert to a fixed rate mortgage. The people who are most likely to be affected by the trigger rate are those that have got their mortgages in spring of 2020 and as early as March 2022, when the prime rate was only 2.4%. So those are the two primary concerns for people who are holding variable rate mortgage right now, and that is that eventually you're going to hit your trigger rate, and then down the road you're going to hit your trigger point. All of this is compounded because even if you don't hit your trigger rate or your trigger point, you're still going to have to make up some ground because interest rates have come up. You've got a fixed payment on your variable mortgage. The least thing you're going to want to do is increase your payments so that you don't hit your trigger rate. The idea is that we always want to make sure that we remain on the same amortization schedule, and by increasing your payments on your fixed payment variable mortgage, you'll be able to stay on track. Now, the Bank of Canada is going to raise interest rates again in a couple of days. We just don't know by how much. Now, you are going to see some people hit their trigger rate, but they should have already taken the steps to talk to their mortgage broker about what their options are. Fixed rate mortgage people, this doesn't mean that you're clear and out of the woods and you don't have to worry about the rising interest rates, because at some point or another you're going to have to renew your mortgage at a substantially higher interest rate. So the best thing you can do is keep an eye on the interest rates and adjust your payments as needed, because if you pay more down now, when you come up to renewal, you are less likely to feel the pinch of higher interest rates. Now, the main takeaway from this is doesn't matter if you have a variable mortgage or a fixed rate mortgage. You should always keep your eye on what the mortgage rates are doing and adjust your plan accordingly. That way, when it comes to renewal, you're not going to feel the pinch, and when it comes to renewal on the variable rate fixed payments, you're not going to have to come up with a lump sum payment to make up the difference in the changing interest rates. So here at the Brantford Realty Group, we work with a ton of qualified mortgage brokers and different lenders so that we can help our clients come up with the specific, unique plan that can help them out. So please reach out so we can refer you to them and point you in the right direction. If you like this video, you're going to want to watch this video right here or this video right here, where I go further into different topics in the real estate market. So I'll see you in the next video.